The economics of owning a hedge fund. Imagine waking up tomorrow and discovering that strangers have trusted you with $10 billion. Not because you're famous, not because you won the lottery, but because they believe you can make them even richer. Now imagine this. If you earn just a few extra percentage points, you could make hundreds of millions of dollars. But if you make one wrong decision, billions can disappear in a matter of days. Welcome to the world of hedge funds, a business where the product isn't oil, it isn't real estate, it isn't technology. The product is money itself. Every day, some hedge fund managers make more money than CEOs of the world's biggest companies. But here's the question. If they're investing other people's money, how do they become billionaires themselves? And what exactly is a hedge fund? Today, we're uncovering the economics of owning a hedge fund. Most people think a hedge fund is just another investment company, but that's not true. A mutual fund usually follows strict rules. It aims for steady, long-term returns. A hedge fund has one mission: make money, whether the market is going up or crashing down. That's what makes hedge funds different. Imagine two investors. One sees the stock market falling and decides to wait. The other sees the same crash as an opportunity to make millions. That's how many hedge funds think. Instead of simply buying stocks and hoping they rise, they use complex strategies. They bet on falling prices, they trade currencies, they invest in commodities, they buy distressed companies, and sometimes they place billion-dollar bets on a single idea. But here's something even more surprising. Most hedge funds don't invest the manager's money. They invest other people's money. Billionaires, large corporations, pension funds, universities, and wealthy families trust hedge fund managers with billions of dollars, expecting one thing in return: higher profits. The more money a hedge fund manages and the more powerful it becomes. But managing billions also means making billion-dollar decisions, and one mistake can wipe out years of success. So the real question is, if the money belongs to investors, how does the hedge fund owner become incredibly rich? So, how does a hedge fund actually make money? The answer is surprisingly simple. The investors make money first, then the hedge fund makes money. Imagine a billionaire invests $100 million into a hedge fund. The fund manager studies the markets, analyzes companies, tracks global events, and makes carefully calculated investments. Months later, that $100 million becomes $120 million. The investor earns $20 million, but the story doesn't end there, because the hedge fund gets paid too. First, it charges a management fee. This fee is collected whether the fund makes money or not. Then comes the real jackpot, the performance fee. If the fund generates strong profits, the manager takes a percentage of those gains. Now imagine this happening, not with one investor, but with hundreds, not with millions, but with billions of dollars. Suddenly, a small percentage turns into hundreds of millions of dollars every year. That's why the world's top hedge fund managers can become billionaires without owning factories, selling products, or building skyscrapers. Their business is managing money better than everyone else. But here's the catch. The higher the potential reward, the greater the risk. One wrong prediction, one unexpected market crash, or one global crisis can erase billions of dollars almost overnight. And when investors start losing confidence, they don't wait. They pull their money out, which means a hedge fund isn't just competing against the market, it's competing for trust. And in the world of finance, trust may be the most valuable asset of all. But what happens when that trust disappears? But here's the truth. Not every hedge fund becomes successful. In fact, some of the world's biggest hedge funds have lost billions of dollars in just a few weeks. Why? Because financial markets don't reward confidence. They reward being right. A single bad investment can trigger massive losses, and when investors see their money disappearing, something dangerous begins. They start asking for their money back. This is called investor withdrawals. The more investors leave, the less money the hedge fund manages, and the less money it manages, the less it earns in fees. That's why a hedge fund isn't just managing investments, it's also managing its reputation. One bad year can take years to recover from. But the best hedge funds understand one important rule: protecting money is just as important as making money. That's why they hire world-class analysts, economists, data scientists, risk managers, and experienced traders. Every day, these teams analyze global markets, interest rates, wars, oil prices, inflation, political events, and even breaking news, because one headline can change billions of dollars in seconds. This is why running a hedge fund is one of the most stressful businesses in the world. The rewards can be extraordinary, but the pressure never disappears. And yet, despite all the risks, new hedge funds continue to launch every single year, because for those who succeed, the rewards can be almost unimaginable. But after all the profits and all the risks, is owning a hedge fund actually worth it? Let's find out. So, is owning a hedge fund actually worth it? For most people, probably not. Because starting a hedge fund requires far more than money. It requires experience, trust, discipline, and the ability to stay calm when billions of dollars are on the line. But for the few who master the game, the rewards can be extraordinary. The world's most successful hedge fund managers don't just earn millions, some earn billions of dollars. Not because they own factories, not because they sell products, but because they've learned how to manage money better than almost everyone else. Behind every successful hedge fund is an invisible business, a business built on research, data, strategy, risk management, and one thing above all else, trust. Because the moment investors stop believing in you, the money disappears, and without money, a hedge fund is nothing. So the next time you hear that a hedge fund manager made hundreds of millions of dollars, remember, they weren't just investing, they were making thousands of decisions, managing enormous risks, and protecting billions of dollars every single day. That's the real economics of owning a hedge fund. But here's something even more fascinating. Hedge funds manage other people's money. Private equity firms actually buy entire companies. Imagine waking up one morning and purchasing a billion-dollar business just to make it more profitable and sell it for even more. In the next documentary, we'll uncover the economics of owning a private equity firm. See you in the next documentary.